Good evening, everyone. Very warm welcome to all of you on this Friday evening. I'm Manohar Vadva here from PMS Bazaar. We have a very interesting webinar lined up today. Uh, the topic of the discussion is investing in private equity via the fund of fund routes. As you all know, the way Indian economy is growing, the current GDP of $4 trillion is expected to grow to close to 10 trillion in the next decade. And investors have started increasingly seeking new avenues of investment where they can take part in this growth story and create wealth. Um, the traditional form of fundraising, which was the capital markets and debt markets, are now increasingly paving way to AIF, and India is seeing a tremendous progress on that regard. In this webinar, as I mentioned, we will focus how the fund of fund route can be a very strategic choice for investing on the private equity. To discuss further, we are joined today by a very eminent guest, Ms. Shashi Singh. She's the Chief Business Officer at Singularity AMC. Welcome to the show, madam. Just to give you a brief background about madam, Ms. Shashi has held leadership roles throughout her career, illustrious career, having worked in top financial institutions, including Aditya Birla AMC, Reliance, ICICI AMC, Religare, and IIFL Wealth Management. Her expertise lies in growth to late stage private equity and listed equity investments with strengths in fundraising, business development strategy, offshore business development, and a far-reaching network that encompasses ultra HNIs, family offices, institutional clients. She holds an MBA in finance and marketing from University of Ajmer. I will now hand over the podium to Ms. Shashi, who will give us a detailed presentation. This will be followed by a Q&A. Request all participants to post the questions in the Q&A box. Over to you, madam.
Thank you, Manohar. Good evening to everyone. And it is a pleasure to be here talking to you all on this category of investments. So, as Manohar mentioned, India is still at a nascent stage in private equity investments. And more so, it's been last 10 years since investors are benefiting from investing in unlisted companies. But what we've seen is most of the benefit has gone to all the large investors, primarily foreign investors and large institutions and family offices in the country. The reasons being two. One, the ticket sizes typically for a private equity fund, which is always structured as a AIF, category 2 AIF, is minimum 1 crore. And most of the good funds will keep the ticket size as more than 1 crore, say 3 crore or 5 crore. This makes it impossible for a normal investor to invest and diversify to build a portfolio of private equity funds or companies. And how do we resolve this? So we have said that fund of fund is the best route to get the retail investors to participate in these funds where otherwise only large investors can participate and make a very diversified portfolio with a small amount of capital. So with that motive in mind, we launched this. Just before that, let me introduce who is Singularity. So Singularity is as a firm, it's just a 6-year-old firm, but the mentor and the team has been very old. So the mentor of this whole business is Mr. Madhusudan Kela. I'm sure all of you all are aware of the market veteran, Mr. Madhu Kela, who was with, for the largest part of his career was with Reliance Mutual Fund, which is now Nippon India Mutual Fund. Under his leadership, the mutual fund scaled to new heights and offered one of the best returns for the investors. Post quitting Reliance Group, Madhu set up his own family office. He was joined by Yash Kela, who's his nephew, to lead investments into private and listed equity markets. For 4 years, we only invested prop capital to ensure that the thesis of investment on the private side that we have is correct and there are no mistakes, because you can't afford to do mistakes on outside capital. once the thesis was clear, we launched funds for external clients. So if you can see, today we are talking about Singularity Fund of Fund 2. Singularity Fund of Fund 1 was a fund which was only prop capital and we invested. This fund of fund is a little different from most of the fund of funds that you see in the country for two perspectives. One, in this fund of fund, so we are not saying that we are the best people to assess the whole universe of all private equity funds and bring you the best funds under one roof. What we are saying is we will try to get access of those funds which are otherwise not available at all to you. So maybe because their ticket size is very high, or maybe because they're taking only institutional money, or maybe they're not distributing their funds. So these are very boutique funds or funds out of access to normal investors, but very good fund. So the best investments go to these funds, and therefore, can we bring these funds to you? Because we, as a large family office and a large investor, have access to all these funds. So in this fund of fund, we are trying to do two things. One, provide you a complete private equity portfolio under one fund. So this is a category 2 AIF. So the minimum investment is 1 crore. Ideally, if you want to make a holistic PE portfolio, normally private equity will not be more than 15 to 25% of your portfolio. Within that 15 to 25%, if you have to diversify across 5-6 funds, you need 7-8 crore rupees, which will become difficult. So here in a 1 crore, we are trying to bring that whole portfolio. In this fund, what we do is 50% of the fund is allocated to these private equity funds, which are otherwise not accessible. And as we move ahead, I'll give you examples of funds where we've invested, which are not available in the market, or there's a price differentiation because of a higher ticket size in the market. So we will invest 40 to 50% of the portfolio will go in funds. So ideally, you'll have about 7 to 9, 10 funds in this. So you are getting to access 7 to 10 funds in one portfolio of 1 crore rupees. The balance money, which is 50 to 60% of the money, will be invested in secondaries and co-investment. Now, what do I mean by secondaries and co-investment? So when we invest in a private equity fund, normally as large investors, we get co-investment benefits. So if the fund is investing in any of the companies and they have excess, they will allow us to invest in that company directly. So here you get access to a private equity company to invest directly through us. So you're making a portfolio of funds. You're also making a portfolio of some direct companies. And thirdly, we'll invest in secondaries. Now, what is secondaries? If you see private equity market and the funds in India are about 10 to 12 years now. In these 10 to 12 years, there have been many private equity funds which are launched. Some of the funds which reach their maturity or are reaching their maturity and they want an exit from their investments, we will go in and buy that. There are two benefits in this. One, you know the company that you're buying, and that's like 2 to 3 years to maturity, which means exit. It can be a listing or it can be a secondary exit. So one year hold period, unlike a normal private equity of 7 to 8 years, here your hold period will be only 2 to 3 years. Secondly, there are sometimes investors who are invested in private equity fund and they want to get out before the maturity of the fund because of any emergency or because they have some requirement of money. Now, in doing secondaries, one, you reduce your tenure substantially and get a benefit of unlisted investment. Also, you get a discount because when I'm going and buying secondary units, I'm bailing out some investor or some fund. So I will charge my premium or the seller will give me a discount because he wants an exit as per his requirement. So here I try to reduce the tenure of the fund for this 40 to 60% of the portfolio. At the same time, I'm getting discounted value. So normally you get about a 20 to 25% discount from the seller or a premium that we charge to enter those to buy those securities. So overall, you're getting a mix of about 7 to 10 private equity funds and about 4 to 8 companies, which will be either secondary units of a fund or secondary shares of a company that we would have bought from either an investor or from the fund itself. So this is how we will structure this portfolio. So you're not getting access only to fund units, you're getting access to companies also over here. So the other thing that is the main USP of our fund of fund is that we will not be charging you double fee. Normally in a fund of fund, what happens is when I invest in a fund, they will charge us a fee like a normal fund. And then my fund of fund will again charge a fee. So it is a little more expensive for the customer or the return gets reduced by that. But in our case, we are not charging anything extra to the customer. Whatever is the underlying fund fee. So normally the private equity funds, the fee structures are 2% and 20%. So the fee is capped at 2 and 20. So normally when I will invest 50% of my portfolio where I'm investing, I don't earn anything. But the balance 40 to 50%, which I'm investing in secondaries and co-investment, is where I get to charge. I get the full charge at the fund house. So in a nutshell, we are saying that you are getting the best in class funds, which otherwise are not accessible in the country. Very expert team, which is able to analyze and assess and then invest in these funds or select the funds to be invested in. Coming from Madhukela's house, we have a lot of understanding on businesses and on capital markets. So what happens normally, founders will have a lot of know-how on their business, but they'll not know how the capital market will view their business when it gets listed or what valuation will be offered to them. On the other hand, a lot of capital market people know how to evaluate a private or a listed company, but will not be able to play the right valuations for a company which is high growth, unlisted company. We have expertise on both the sides, which is a big asset for us, and the network. See, in unlisted companies, it is not like all the shares are listed on the exchange and you can see. So you have to have a very good network and access to get the best transactions in the market. And with our 24-member investment team, we have deep network and deep access to get the best transactions in the country, both on the fund side and on the secondaries and co-investment side. And we have been able to make the tenure very sharp, while the fund of fund tenure is 10 years, because we will invest in funds which are across early stage, growth stage, late stage. So there'll be funds where the tenures are 6 years, 7 years, 10 years. So we have to keep as a fund of fund the maximum tenure, which is 10 years. But you will see the money back on the table faster because my 40 to 50% of the portfolio, which is in secondaries and co-investment, has a tenure of 2 to 4 years. So I will invest and then when I exit, I pay out the money back to you. So unlike if you would have invested in a fund, तो आपको 10 साल रुकना ही पड़ता है, इधर आपको पैसा जल्दी वापस मिलता है. So we are saying we are sharper tenure. I will now move to some of the funds. So this fund of fund is a 500 crore fund of fund. Just go to the terms. Yeah. It's a 400 crore plus 100 crore green shoes of 500 crore fund where we, as you can see over here, we are charging a 2% fee and a 20% performance fee. And in the bottom, we have already written that this includes the underlying fund fee. So there will be no overcharging. We always believe in very strong sponsor commitment. So at least 10 to 20% of the fund is always committed by the sponsors, which is the 𝐀𝐻𝐨 family. So 60 crore of the capital is provided by as sponsor capital by the 𝐀𝐻𝐨 family. So that's about how it is. Now, From this fund is already raised about close to 250 crore. We have invested in some funds, and I'll give you examples of some funds. So to elaborate as to when I was saying what kind of funds will we invest in. So if you see these funds, so say for example, SFOF Continuity Fund 1. Now in the market, you might have seen SFOF Fund, but SFOF Continuity Fund 1 is the what they call as follow-on fund. Yeah, Fund 1 ke winners will be in, they will double up on the winners through a continuity fund. Now this fund is accessible to only to their Fund 1 investors. Since we as a family were invested in Fund 1, we got access to that, and that is what we have used for the fund of fund. Similarly, like CX Partners does not raise retail money at all. Or Title Capital, again a winners fund. It is the fund by Snapdeal co-founder 𝐀𝐛𝐨𝐰. Now he has this fund called Titan Capital. We were invested in that. Now winners of Titan Capital Fund are into Titan Capital Winners Fund. That's the fund we have invested in. There is a fund name called Atomic Capital. Atomic Capital is a fund launched by Mr. Apurva Gautam. Very classic early stage VC fund where he does not play a spray and pray game. He will invest in only 9-10 companies, get involved operationally with all the companies to support them, mentor them, and ensure all the companies become winners. So now he does not raise capital from the larger market. He has only large clients as his investors. So we have invested in that fund because of the connect that the family and we have access to him. Then Mount Tech Growth Fund 𝐬𝐻𝐞𝐚𝐤. Now, Mount Tech Growth Fund 𝐬𝐻𝐞𝐚𝐤 is launched on the back of the thesis of Government of India to make India a product first nation. So Government of India has identified 9 sectors where they want to focus on getting strategic autonomy on manufacturing. Defense, aerospace, digital communication are the sectors that are identified. Now, Mount Tech Growth Fund is launched by ex-Defense Secretary of the country, Mr. 𝐬𝐩𝐞𝐚𝐤. We have access to him. Mr. 𝐬𝐻𝐞𝐚𝐤, in fact, is an advisor on the board of our other fund. And that's why we got access to this fund and we've invested in this fund. So these are the kind of funds we will invest in. We've already invested in these 9 funds that you can see on the screen. We will share the presentation with you, and we've given details about each of these funds also. Some of the companies that these funds have invested in their earlier fund or the current fund, I'll just take you through that. So if you see some of the funds that are there, and these funds on the left-hand side have invested in these companies. And these are the companies we could get for co-investment as we move ahead. This is just a representative of the kind of companies these hold, like SFOF VC that we were talking of. One of their most successful investment is 𝐀𝐻𝐿. I'm sure all of you all are aware of 𝐀𝐻𝐿, the travel luggage company. Then Supertails, which is into pet items that are there. So then Artha Venture Fund, where Agnikul is one of their investment, which has given the full funds return as a single company. Similarly, if you see 6th Sense, it has a lot of winners in its basket. 314 Capital. So Titan Capital, the Kunal Wealth Fund invested in 𝐬𝐸𝐞𝐚𝐤, which is a big success. Cure Foods of Iron Pillar. So these are companies, as they top up in their winner funds, if we get opportunity, you get to participate in these companies also through co-investment route. So if I show you, so as I was talking to you about early stage, growth stage, and late stage, normally one would focus on one stage, or a fund is focused on a particular stage, except for 6th Sense funds. There is no other fund in the country which invests across stages. But because 6th Sense is a consumer-focused fund, so in consumer, they invest across all stages and companies. But for this portfolio, we will take a mix of early stage, growth stage, little bit of late stage if we get, so that you get a holistic PE funds portfolio and also you get secondaries. So these are some of the funds that we have invested from our prop capital in the fund of fund one. And also the reason why we get their access to their winner fund and their co-investments. So just to share with you, what kind of returns are we expecting over here? So normally you should expect the drawdowns in this kind of fund of fund to happen over a 3.5 to 4.5 years, because early stage funds will draw down a little earlier, growth stage funds take a little more longer to draw down. But on an average, every fund's drawdown spans over a 2 to 4 year period. So we expect the drawdowns to happen over a 4 year period. And we expect from the 5th year money to come back to you through our secondaries and co-investment bucket that we are investing in. So that's how the fund will be structured. The drawdown amounts will be about close to 10 to 20%, and you should expect this every 3 to 6 months. As the fund will call for drawdown, we will call for the drawdown. Normally in drawdowns, you get a 20-day notice period to make the payments. I will just show you the performance of our fund one. Generally, we target 18 to 22% IRR in these kind of investments, because it's a mix of early stage, growth stage, and late stage. Our fund of fund one, the pooled IRR is 20.67%. It had 18 funds in it and a few co-investments. The benchmark IRR, if you see CRISIL benchmark returns that come out of all the funds, is about 16.6%. For the current fund of fund also, we expect to do around, as I said, between 18 to 22% gross IRR. The biggest benefit for investors to look at from the fund of fund two is that you're getting in 1 crore, you get to access the best funds in the country to the best managers, and you get to invest in secondaries and co-investment also. So I will take a break here and leave the floor open to you, Manohar, and the team for any questions that you have on this.
Sure. Thank you so much for the insightful presentation. The very fact that this fund is giving a complete PE portfolio in one fund through seed funds, buyout, and co-investment, I think most of the participants will surely look forward to more details on this. Coming to questions, I have a few before we could take a few more Q&A questions. Just want to understand, given the fact that the capital markets have seen the corrections, has this affected the private equity space by any chance? And how does private equity now look, even in comparison to the listed market, given the fact that you actually have both these funds under your forte? Yeah.
It's a very relevant question, Manohar, in today's market. So normally, private and listed markets move in opposite direction. So last 2 years, when we were seeing the listed markets heated up or going crazy, the private markets were at its bottom. And last 2 years have been the best time to find the valuations. And this started post the IPO of, say, Nykaa Paytm. And when the markets, the private founders realized that, the kind of valuations that they're looking at without any EBITDA positivity is not what capital markets will value add. So we've seen a lot of sanity coming in the valuations in the private market. So last 2.5 years have been very good to find the best private market deals. We've got 2 private equity funds where we are at about 35% plus IRR in both the funds currently. So I would say you're getting good deals. And because of these recent IPOs, which have not fared very well on the indices, 2 things have happened. One, founders have got tamed down on the kind of valuations that they're expecting. And they understand that the market will value only EBITDA positive companies. So you can't keep cash burning and then increasing your revenue, but not looking at the bottom line. So the bottom line visibility for the founders has also come in, which is very helpful. Coming to the listed markets today, from like mid-Jan, we've seen some correction, but that was expected because the listed markets had run up quite high. We're still finding good value in the private markets. And what has happened is that, a lot of new age businesses, you don't to get to participate in them through the listed market because listed may exist in nahi karte hain. Say, for example, today, drone companies are very high growth areas, or transformers are very high growth areas, or anything to do with energy transition, say battery recycling, and all these are very high growth areas, but you don't find listed companies there. So those kind of unique gems, which are very fast growing, where there are government initiatives, lot of incentives, you can participate through the private market, and we indulge in that, and we're making, plus the omni-channel or e-commerce boom that has come has helped a lot of consumer companies. So we focus a lot on energy transition, consumer, industrials kind of businesses, and you find good companies and good valuations over there. So private market will continue to be a lot more robust in select areas where you can't find opportunities on the listed market.
A related question, given the fact that the markets have given the returns have moderated. If you look at the 10-year return on the listed market, it's down to 10-12% for the Nifty or the Nifty 500. In that context, what sort of IRR can be expected from these kind of private equity funds or the fund of fund route which you are managing? And you think it offers more lucrative opportunity compared to the to the listed market?
Our general thumb rule is that 15 to 20% is what one should expect over a long period of time in listed markets return, which can be compounding at 15 to 20%. And from private markets, you should expect 20 to 25% return, because there is some illiquidity premium one will expect, right? Because in a private fund, you are locking your money for at least 4 to 8 years. So unless you get that premium, it makes no sense in investing in a private fund. Having said that, you can see times when in the last 2 years, listed markets have given 40 and 80% returns, but there are times like before that market when the markets didn't give. But I'm saying on an average, over a long period of time, listed market, if you are able to manage 15 to 20% compounding return, it's very good. And for private, you should expect at least 20 to 25%.
Okay, some viewers Q&A. So they want to know, how do they keep track of the performance? So you will, so ideally you'll be sending a quarterly update.
We have a very detailed quarterly update that goes out on all our funds, including the fund of fund, where we will talk about which funds we've invested in, what are their metrics, where have they invested, all details, and the NAV is published. So there's a quarterly NAV of the fund, and there is a publishing of the portfolio. Plus, we do once in 6 months, we do a client webinar for all our clients, where we call them and the fund managers talk about the portfolio, and we also call some of the underlying fund people to talk about their funds.
The other question was regarding the investment for accredited investors. Is that option available, and how much will it be?
Yeah, so accredited investors have no SEBI limits for investment, right? If any investor has got a AI certification, he could go and invest 50 lakhs in an AIF also.
Okay, that's great.
So that is a thing which cannot be said no to any investor in any fund.
Okay. Another question, how do you see this private equity as an asset class growing in the next decade?
I would say as an allocation, every investor should have at least 15 to 25% of allocation to private equity, depending on their risk appetite and various profiling of the risk to be done. The reason being very simple, that you generate your alpha from here, just like debt over equity, equity over debt, we do because of generating alpha and wealth creation. Secondly, a lot of high growth businesses are new age businesses. So if I have to compare the growth of Hindustan Unilever versus the new age companies that we are seeing today, there's a huge differential. So how do you participate in these high growth companies? You have to go through the private route, and post listing, 60 to 70% of the run up of a company is before listing. So you will miss that if you're doing only listed markets.
Got it. So within the mix of your product with this primary, secondaries, and co-investing, which pool of or which combination do you think will be responsible for the highest returns, IRR returns? I mean, is it just to understand, where is the the alpha going to be generated from?
It's very difficult to pinpoint like this what will give you the best return, because ideally all three stages should be giving you 20 to 25% return. But like if I give you an example, we invested in Wari. Okay, that's been a bumper return. We invested in Zota Healthcare, which is a generic medicine retail stores. We made what 10x return on that. Now, when we invested, our estimate was not doing 10x return, right? But it did well. But I would still maintain that the average return that one could expect is 20-25%. Some companies will do very well, some might do average.
Got it. Another question is, do you believe investing in a fund of fund route is a far better approach than having a direct private equity investment, or a direct PE fund?
Very valid question. And I would say the first thing to assess while selecting whether a fund of fund or a direct route is what is the corpus you have. If your portfolio size is more than 50-100 crores, then you could always select the funds directly. You'll have access to the funds and co-investments and do it directly. At that time also, do you have the wherewithal to do the assessment which fund to invest, and once you've invested, to monitor which funds you've invested and the companies you've invested? Fund of fund route is normally for investors who have portfolios of say 10 crore to 25 crore, where you can't allocate more than 1 to 2 crore to private equity. And within that, if you need a complete portfolio, our fund of fund, one more benefit that you're not double charged. So your cost becomes optimized over here.
Okay. And so how many fund of funds will you invest within the primary, and how many within the secondary? Is there any, and how much will be the allocation? Allocation in the sense per fund allocation, minimum, maximum, something like that.
See, 50 ballpark 50% of the fund will be invested into primary funds.
And you've already done 9 of them.
9 we've already done. I think we've completed our primary funds portfolio more or less. We may add one fund or may not add. That's it. And the allocation depends on the underlying fund size and the stage. So if it is early stage, the allocation will be little less. If it is growth or late stage, it will be more. But the range is between 10 to 50 crores per fund.
Okay.
And then the secondaries and co-investment. Secondaries and co-investment is very opportunistic depending on what size you are getting and what as a percentage of the fund you want to allocate to that kind. Taking into account you already have an allocation through the fund that you've invested in.
So just coming back to the so a lot of questions as to what is the minimum investment, etc. I'll just like to explain this again. The minimum ticket size is 1 CR. This is as per the SEBI mandate, and that's how this fund is also taking it. And the drawdown at present is 20%, and it will be typically spread over 10 to 20% over a 3 to 4 year period. Am I right, madam?
Yes. No, the drawdown will be over 3 to 5 years, 3 to 4 years.
3 to 4 years, yeah. Okay, and that will be on a frequency of maybe
3 to 6 months. every 3-4 months you'll get.
Okay.
But initially थोड़ा टाइम लगता है क्योंकि जैसे से फंड रेज हो रहा है, नया पैसा था उसका 20% आता जाता है, so we don't call for new money. Once our fundraise is complete and we expect कि ये fundraise अगले 3-4 महीने में complete हो जाएगा, उसके बाद फिर regularize हो जाता है.
So one question was, if you're investing in early stage, shouldn't it be under Cat 1? I mean, is that a relevant point?
Pardon?
So there is a question, since you are investing in very early stage, shouldn't that be categorized as a Cat 1 instead of Cat 2?
So no, most of the funds or all of the funds that we select will be registered as Category 2 funds. Category 1 funds are angel funds, which are for very retail investors, where your per investment ticket size, per investor ticket size is 25 lakhs only. And there is a ceiling on the underlying investments also. I don't think we are operating in that bucket. And for the investors also, if I have to do Category 1, that they have direct access to, right? What I'm trying to bring is what they don't have access to.
Correct. A little bit about your first fund performance. So if I see at present the TVPI is at 1.63 and the carry IRR is around 20%. So what are the sort of winners you have from your first fund, and how long is that fund going to last?
So the fund 1 has, we've already started getting payouts from the funds, and I think we are still 2 years to maturity now. It was a 10-year fund again, because there was some early stage in that. But some of the funds that we've invested in, so the funds of our fund of fund, like 314 we've invested in, SFOF VC we've invested in, 6 Sense we've invested in. These are the funds. This is the portfolio of our fund of fund 1. Artha Venture Fund has been a very good performer. We've invested in Bloom, which is a leader in the early stage funds. Necessary Ventures has been a good fund that we invested in. So all these funds have been winners for us. And we've categorized as stage-wise, early growth and late, and also sector-wise, because each fund operates in a particular sector. So we've categorized across board. So if you see below, we've written the investments were done between 2016 to 21. So the drawdowns have happened from 2016 to 21. Now the payouts have started.
Okay, thanks. So as you're entering into this new financial year, what is your outlook on the Indian economy? And in turn, how do you see it helping your fund investments?
So the market will not be as easy as it was last 2 years, for sure, especially on the listed side. And same goes for the private side. So one has to be more bottom up, more selective. As a fund house, we are not contrarian players. So we go with the tailwinds. So if India has to become a 10 trillion economy, what leads this growth? The sectors that lead this growth is consumer, financial services, technology. अगर ये तीन नहीं बढ़ते हैं तो India 10 trillion बन ही नहीं सकता है. So we will also be focused on these sectors. Additionally, globally, we feel the theme for next decade is climate and energy transition. So we want to play that because it's becoming a big theme, and that is जो हम पूछते हैं कि अब ये next 10 साल के लिए क्या बड़ा game होने वाला है, it is in this sector. So we're very focused and very deep on this sector that we invest in. Listed markets mein one has to do a lot of bottom up investing now, because we will not see the free flow of capital that we saw in the last 2 years, which also determines a lot on the stock prices that we see. Fundamentally, there's nothing gone wrong. In fact, some of the good things that have happened in the government's favor is that, if you see from March, April onwards, government spending was very less because of the overhang of bad election results. Focus on now that they've got these 3 victories in the election result, the government is also far more confident in driving the agenda which was charted out 10 years back when they came into action. So we see a lot of positive tailwinds, but what is out of our control is the global one geopolitical turmoil that happens, and with the new US president, every day you wake up, what news is coming. So that impacts and that makes the market volatile.
Another question is, are investors, so this is an NRI who's asking, how do they route the investment into this fund? Is there a gift feeder fund available, or and also do you take money from US investors?
So one, from US investors, we take money, yes. NRIs can directly also come into any AIF that they want to invest in through their NRE accounts, if that's fully repatriable. We do not have a GIFT City feeder for this because this itself is a fund of funds, so it feeds into other funds. So for this fund, we don't have a GIFT City feeder.
And so some questions on the taxation part. So this will be a pass-through taxation,
yes,
right?
This is a category 2 fund. So long-term, short-term capital gains. Normally, it's long-term capital gains, either listed or unlisted securities, but it's all pass-through. So nothing is deducted at the fund level. It is at the customer level, and we will give a tax statement, capital gains statement.
Okay. Another question is on your exit strategy.
Yeah.
So basically, is it totally dependent upon the IPO market, and maybe in a year like current, where the IPO market has suddenly, fallen off the radar, or rather there's a cooling off of it. How does your team, look at the exits?
So one, for the 50% part of the fund, which is investing in other funds, is the exit strategy of the other funds. But from their underlying portfolios, we can say normally there are 3 ways exit can happen in any private equity fund. It is through listing, through secondary sale to another entity or another investor, and through strategic sale where the company is bought over by a bigger company, like Urban Company got bought by Reliance, Clovia got bought by Reliance. Normally, when a fund invests in a private company, at growth stage, they are very clear how the exit will happen, because there the investment horizon is, say, 3 to 4 years. But if it is an early stage investment, normally the exit is a secondary exit, because there your investment horizon is 6-7 years and you're coming very early. You don't expect the company to mature in that period. So you're not exiting as an IPO for sure. Overall, if I see from the portfolio, about 40 to 50% exit should be through listing. Balance should be through strategic and secondary.
Okay. Yeah. So the next question is, with India being home to third highest number of unicorns in the world, what are the new trends or sectors emerging out of the startup boom in India?
So as I mentioned, consumer, of course, continues to ride this. And consumer is a vast segment, which also includes digital innovation that's happening, quick commerce, e-commerce, all these companies that are helping a lot of consumer brands that are there. Secondly, energy transition, which I've touched upon, is a big sector which is emerging. And when we say energy transition or climate, it is not only EVs. In fact, we feel that EVs are not where you can make the returns, but battery recycling, battery materials, battery minerals companies is a huge focus area. Government's trust, government giving a lot of incentives, and companies coming and making good returns. One of our portfolio company in our private equity fund is growing 100% every year for last 7 years. That's the kind of growth we've witnessed. Other than that, industrials, which is new age manufacturing, that is a big theme emerging because of the government of India's push of incentives to make India a product first nation. Government has identified 9 sectors, and those sectors they focus. So we will also focus on those sectors.
Do you also invest outbound, or is it all mostly within India?
it is only investments in India.
Yeah, fine. I think we are almost done with all the questions. I would like to thank all the audience for joining this session. I want to thank the entire Singularity team for being present in this and running us through, giving us all the deep information which is required. Thank you so much for the call and have a very pleasant evening. Have a great weekend. Thank you
Thank
so
you so much, Manoj. Thank you all. Please feel free to reach out to us for any queries. Thank you.
much.